Welcome to the More Than More podcast, where we discuss building meaningful, impactful businesses, careers, and lives through real estate.
Okay, welcome back, gentlemen. It's been a couple months.
Husband feels just like yesterday.
It is a lot of work trying to rally you guys.
Is that in November?
Yes.
November.
Okay.
That's what 2 months
That's
is.
2
If
months.
you go backwards.
Well, I don't know if it was October or November.
Chris was late. Jason's trying to buy a truck.
Ethan's complaining about the time.
I'm just trying to
needs
get
leave.
somewhere.
Hey,
done yet?
you hit 1,000 sales this week.
I did, yeah.
I thought I'd
1,000
use this.
Congratulations.
transactions. Yeah,
Wow.
thanks.
Big number.
A big number, and yeah, feels like another number though. So
And one of your, hold on, is the thing you're doing with your clients, is that still secret or is that out? Is that public?
it is. It will be public, I think, by the time this is out. Yeah. No, it is. Yeah, we're giving away a free mortgage for a client for a month.
Nice.
So,
That's
yeah, we're
awesome.
doing that now. So yeah, we're excited about it. But
Is there a way for me to be on the list?
yeah, you got to buy a house in the next 1 week.
I'm actually shopping. I'm looking
Oh.
for rentals right now, but it's tough.
Yeah, let me know if you find a couple.
You're my guy.
Oh no, I want to buy one too. I don't want to help you buy it. I just want to buy one.
Comes with a free mortgage.
Yeah.
Okay, well, welcome. It's been a couple months. I think the commitment was that every 2 months we're going to get together and just talk about where the market's at, what we're seeing, and maybe debate and take bets.
That was not the intent.
No one told you to do it. Have you been working on designs at all?
Oh, yeah, definitely. Yep.
It's really good. I know Jason has too for you.
Planned out.
Let me just start here. What are you guys feeling right now? It's mid-January. What's it feel like in the marketplace? What are buyers and sellers feeling, thinking?
Well, I mean, I think buyers are picking up as far as number of activity. I mean, I've heard from multiple agents. We had a couple open houses this weekend, and other agents had open houses, and there were 9, 10, 11 people,
Yeah.
12 people at these open houses. So whether that's going to relate to transactions right away, at least it's good to know that people are out there looking at stuff. But
I never know if it's anecdotal me or not, but I feel a lot better this time than I did this time last
You're
year.
just watching less bad TikTok this time than last
Stop
year.
Stop it.
So you're seeing activity on listings.
Yeah, it
is that
feels
what you
like
mean?
it. Yeah, and buyers and the general sentiment feels better than it did this time last year, I would say.
100%. There's people looking, they're buying. There's first-time home buyers. There's people upgrading. There's people doing everything.
Our numbers, it's hard to tell as well because we've got more and more great agents doing more and more great business. So sometimes it's just we're growing, but our activity for the first 2 weeks is super strong. Just new pendings. So, and I know listings are coming in fast and furious as well, and I think that's good too. So we'll get to that in a minute. Chris, I got to pick on you because you're so easy to pick on.
Okay.
I saw you got into a market-based debate with our old friend, Mr. Scheib.
No, why you looking?
Wow.
Why are you creeping on me?
Because I saw it on TMZ. It went public. So
Viral again?
No,
I can't wait to watch this.
Somebody sent me that, and I never
was-
responded to one thing, and I just responded to that. So
when are you going to learn not to respond to things publicly on Facebook or Instagram?
I've learned my volume on responding to those
Has
has
gone
gone
down.
down like 90%.
And
so.
your joy and happiness and
is
peace
true.
has gone up
It has. It's true.
But Tim pops up on my feed
a lot.
a lot.
Yeah.
Well, yeah, he makes a video a day, so it's hard to miss.
At least
after
Every
a while.
time I
Okay.
go on, I just stay off Instagram now.
Okay, so not to pick on Tim because that's not the point. Tim's saying repeatedly for the last 2 years, rates need to come down, rates need to come down. So in a way, he's almost echoing what Trump would be echoing and just saying, we want rates lower. So I've got several thoughts on that, but you decided to respond and say, no, dummy, that's a bad idea.
You
Explain
did?
it. Yeah.
I did. Yeah,
wow.
I don't think rates need to come down at this point. Do you think rates need to come down?
100%.
Oh, come on. You guys are crazy.
Explain.
If we're talking about the whole theme of our last podcast was affordability. So why do we need rates to come down?
Because it makes homes more affordable.
It doesn't, because it just shoots prices back up, and we're at a good spot price wise where we're 2 to 4% appreciation at this point, And so to take rates down to under 5% or wherever he wants them to go, I just think that's a really bad place to be at this point. And you disagree, and I'd love to hear why. You being Jason.
You can just see his body posture.
Yeah. It's just so defeating to hear you say that.
So
Rates need to
defeating.
stay high.
So defeating.
No, I definitely think they need to come down in a gradual fashion. KCM report, if you listen to that, it's found in the codes or passwords page on the drive.
I did listen to it. Thank you.
Goes up on an elevator, comes down on the stairs, and that's what their quote was
For
in
sure.
the show. And I think that's really good. If we bring the rates down too fast, the refi situation is going to be crazy. The people upgrading homes is going to be crazy, and we're going to have price appreciation.
Right.
I don't disagree with that, but the point is we've been at 6 for too long, and we do need to get in the mid 5s, the low 5s.
What's too long? It's been like 6 months.
Too long. Never should have went that high. We have an affordability crisis, and we could fix it with rates.
But there is a seesaw. I don't even know what to call this. It's a tug of war. You can see that on either end of the seesaw, rates going down makes things more affordable, objectively. But rates going down also inclines buyer activity and then multiple offers, and then that's how we got the price increase. So it's like these two things are on opposite ends.
But there's got to be a balance.
Yeah.
Right? There's got to be a fine line that we hit that. And I would argue we're probably pretty close to that fine line.
It's my argument as well.
I don't think 6 is where we need to be, but I think I could see 5.25 to 5.5 is the fine line. I think if you're there
For a year.
And then down more?
Sure.
Wow.
In the 4s.
I just think with
Houses are too expensive.
Well, that's my point.
but
And he
So
does.
I will rebuttal.
He does have a point. I mean, it would drive prices up, wouldn't it? Go ahead.
But here's my point. We have, and you could argue both ways on this. Rates went to 8, whatever, 7, upper 7s here. Home prices did not go down. So how do you ever, home prices aren't going to go down.
But they stopped going up, though.
That's correct,
Right.
which is great.
Yeah.
But now they've been level for 2 years. And so at some point, 1 to 2% appreciation needs to become 3 to 5% appreciation again.
I think in Iowa it said we were 3.8% or something.
4.7 was what the
National
price went up in Iowa on the report from our meeting notes this week.
Okay. So, so we're right there in that range. I guess what I would argue is that if rates went down 0.5%, to me, I don't see prices going up by 10 to 15%. I could see them going up 5%, which I think is needed, normal, is a good investment for a home buyer if their home is appreciating at 5%.
Another reason why is because people, if rates do drop 0.5%, there's going to be a large part of the majority of the populations that's going to say, well, I'm going to wait 6 more months for it to drop another 0.5%. They're always going to wait because it's always going to be better. And so we needed to get some of the people off the fence. And 6 isn't doing it, I don't think.
So
I would disagree. I think the recent drop just did that.
from like the 6.25 to under, or 6.5 to under 6 ish.
5.9.
Yeah.
I think
It
it's
did what? It did what?
I think it pulled some of those people off the fence. And I would agree with Jason that we do need to pull people off the fence. So at what level and at what?
I just think the price of homes is the more important thing to look at here rather than the rates. You have to stop the price from going up.
That's
and
worth
if you
challenging,
can't,
though, which is actually a bigger lever. If you, I haven't done this, but I have an instinct about it.
The math.
I think that rates actually have a larger proportionate impact on affordability than
100%.
price.
the math that goes every time. The bigger tool to affordability is rate versus the price.
I mean, if you're talking about 6%
If
versus
our rates
3%,
were 3%, yeah, you'd get $200,000 more home.
We need to do
Okay.
the math. 0.5% of drop of increase versus that house increasing at 10%. So you got a $300,000 house. All of a sudden, rates go to 5.5 versus 6. Now you got to pay $330 for that house. What's
Yeah.
more affordable? I would probably say the 5.5% rate at $330,000.
I think you're right.
well, we can't look at the math in this moment. But
No,
I would disagree.
I don't think you're actually all disagreeing that much, but I think that the point is being made, which is what I wanted. there is two sides of this pendulum, and I do think they are at war with each other. What's inevitable, I think, is that rates are going to keep going down with this mortgage-backed security purchasing program, this bond purchasing thing. And
Who did that?
Huh?
Who did that?
Trump announced that. Is this a political?
It is.
Statement?
It's a completely
Oh my
political
gosh.
statement.
You fell for it. I did fall for it.
I was like, there's no way you didn't know about that.
Let me get to that in a minute. But rates are probably going down, and there is a concern, and we should all have that concern that could lead to prices reinflating. We've done a good job curbing that. Nobody wants it to be super unbalanced. You're saying, Ethan, the whole point is to get to that point of equilibrium, and somewhere there's a magic number that, in terms of rates, that gets enough demand that inventory doesn't keep skyrocketing and everything kind of gets to some sort of new normal.
Correct. And I think it's 5 to 5.5.
And you're on Team Tim now.
This is Jason is on Team Tim. Yes.
Yeah.
I'm saying if I were running the country, which I don't have my own
Heaven
country,
forbid.
if I were, I would let this normal spring market run its course. I would get midsummer, have a little boost, get us in that 5.5 range this summer. That would control how much of a swing we have, and then by next spring everything's leveled out. And I'd let that run for a good solid year to 18 months.
And I think we have stair step down, like you alluded to, very slowly. And if we do any more big drops, it's going to feel more like that falling down the elevator shaft.
We've been at 6 literally for a year and a half.
We were at 7 this time last year. So,
and I just want to put I'm not going to offer up any tattoos, but I'll put a flag in the ground on this one. Surprisingly, I'm actually kind of on Team Chris here.
wow.
I love the idea of slightly lower rates, but I love that we've taken now 2 years to normalize the market, to get inventory to start to stack back up. And I do think 6 historically is actually a very good rate of interest. It's just that prices plus rates plus wages, we've got some catch up. But there's 2 ways to catch that up. You make another rash decision to relight the fire, or we let it slowly but surely continue to normalize itself out. So I prefer the safe, steady path to normal versus another intervention. Maybe I just don't like government intervention in markets.
Here's what I would say. I feel like, what I just read, last week, 2 weeks, there's now more people that have an interest rate above 5% than that have it below 3 or below 3.5 or something. And I think that's a great spot to be. I don't think it's all the way there yet. I think if you got to 5.5, and you hung out there for 12 to 18 months, now all of a sudden you have a lot more people in that. Now the people that bought when rates were at 7, now 5 years from now, they're going to feel comfortable buying a house. The people that bought 2 years ago may need to relocate. They're not going to hold. Right now we have everybody holding on to their rates. Now, if we stay at between 5 and 7 for the next 4 to 5 years, people aren't going to think about rates as much when they go to buy again or move, which I think will help with demand, supply and demand.
So you're saying people just get used to paying more?
Well, at some point they just don't have a choice because they have enough kids that they run out of
bedrooms. I think more and more people will continue to move because of jobs, divorce, death, all the D's that we talk about. And at some point, those people out leverage, which we've already started to get there, the people that have 3% rates that are holding on to those. And the more people we can get at a 5 to 8% rate, the likelihood of them reselling in 5 years is going to be a lot more likely than a whole bunch of people with 3% to 4% rates.
Okay, let's pause for a second. Just so that for people listening, I want to get to some of the data so we can come back to some of the debate. Couple things first, though. In the news the last few weeks, I mentioned one, Trump's bond buying program. We got I think it's $200 billion in bond purchases. Fannie Mae, Freddie Mac, he's instructed them to go and buy a bunch of, I think it's mortgage-backed security, so basically loans from banks. The effect of that means banks no longer have those loans on their books, which means they've got more free cash and they can, as a ratio, go give more loans. And when they can give more loans, they can decrease their margin on those loans to be more competitive, and being more competitive will drive the rates down. So it's not impacting rates through the Fed funds rate, which, how banks lend to banks. It's impacting rates by freeing up liquidity in the banking system, encouraging banks to go compete. And that's already been announced, and I think it's actualized, right? So any effect from that I think we're going to start to see here in the next couple of weeks because there's a trickle there.
My mortgage guy said they saw it immediate. Market responded immediately to that.
The
Dropped
market,
a half a point.
The market drops that point, but I think the liquidity takes a minute to actually start showing up on the bank's books. That actually encourages at the local bank level. They have their board meeting, they get together and they say, whoa, we've got, our ratios are much better now. Let's go ahead and let's drop our rates to go be competitive and beat Bank B. So I think that the market responds instantly, but the actual liquidity takes a minute to flow through the system. So that was interesting. What is that saying? It's saying another reason why rates might come down slightly more. And then the other thing that I thought that was interesting was this investor purchasing moratorium. It's not a thing, but I think Trump has been clearly or emphatically stating that his intent to create either like a 6-month not a 6-month. I think it was a 60-day waiting period on any residential properties. When they come to market, 60 days must pass before an investor can buy them. And by investor, I think we mean large corporate buyers.
I don't see how that practically works at all, but.
Well, they did it with short sales for a while. I mean, that's what it was like in 2010, 11, 12. There was a moratorium on investor purchases. You had to be a owner-occupant to purchase those properties for, or maybe it was not short sales, it was foreclosures.
Yeah. They still have 10, 15 days on a lot of the HUD stuff.
I'd be upset as a seller if I'm listing my house and I can't get top dollar because
that's the problem. It's going to go through legislative and legal hurdles because people will fight on that and say you're infringing upon
and if you see rights. The stats, I don't know. At first I was like, oh, okay, that makes sense. It sounds like a good idea. But I think in the last 12 to 24 months, the percentage is only like less than 2%. Definitely, I think less than 5% of sales across the whole country are actually these large corporations. So, yes, it might help in these little pockets across the country, but I don't.
The majority of them is actually people like us. It's most of the investor purchases are mom and pop rental buyers like us. Yeah. My thought on that I don't know if it's valid or not, but I thought of Caliber Homes here locally. I was like, is the problem that large investors are buying real estate, or is the problem that so many builders have actually moved to a model of construction that is build to own, build to rent? I mean, think of Caliber's just done amazingly here, right? But 99% of what they're building, not Caliber Homes, Caliber Iowa, all the stuff they've built, they've never intended to sell. And so how much new construction energy and capital is being injected into constructing stuff that's never going to hit the market for the end consumer.
Yeah.
So, okay, that's news. And then let's just talk through some of the data real quick. So jump in on each of these respectively. Let's start with prices. If you're listening, there is a packet. We've just stolen essentially a handful of the KCM slides from the most recent report. As always, Chris, you should listen to this every month.
Yes, it's very good information.
Yeah, last minute we had to send the login information to Chris. If you don't know where that is, Jason, where's the login information?
It's on the drive in the password and codes file. KCM.com.
Now, be honest. Did you know that this morning, or did you?
You really did? I went to drive and I typed in KCM and nothing came up. So I was like, well, it must not be there anymore.
Well, what I first did was I typed in KTM. I'm like, no, that's a motorcycle.
That's a motorcycle. Wrong one.
How about you, Ethan? Are you better than Chris at this?
I mean, I knew where it was. I don't.
Watch it?
I follow their Instagram stuff, their social media. And I just came back from Top Ferry Conference where the head of KCM was just there. So I literally just heard all this.
Did you see my dad?
I don't know. Might have. Yeah, I did see her. I could see
okay, we're off track. Sorry. Can I make a plug? I honestly believe that one of the best investments of time I've made over the last 15 years is literally just listening to this. It's 20 minutes long, once a month. Put it on the calendar. It's the 12th or 13th of the month to be safe. Put it on your calendar as a reminder to yourself. Log in, 20 minutes of listening. You will be more informed and more articulate on the marketplace. So there's my plug. Chris, I'm talking to you.
All right, that sounds good.
Check your award rankings and listen to KCM.
Those are your two things.
Those are the two most important things you can do.
If you want to know when award rankings come out, call Jason. He knows within 3 seconds.
Or you don't have to call him. He just texts me out of the blue. Hey, I see you had a good month. Or I'm like, I had no idea what you're talking about. But
It's his way to say, did you see my month?
Yeah,
Look
pretty
at the-
much.
look
It's
at
like,
the prices.
Hey, you had
Look at the
you had a great
prices.
month, but you're still not above
Man, prices are cooling.
He's blushing. Look at this guy. Okay, so let's just run through some of the data points. So prices, 1.6% is the current. Actually, can I do this in a different order? Let's just do it in the order of the slide. So inventory. Let's start there.
Okay.
So the current projections are that next year, this year, they're looking at a 10% continued increase in overall inventory. And if you look at the first slide we have, where we sit right now is above 20, 21, 22, 23, and 24 inventory levels. And we're really following the trajectory and curve of the pre-pandemic trend lines now of 17, 18, and 19. So I think that's just an argument for inventory has normalized, and we're no longer in this 4 or 5 year haywire period where there was nothing to sell. And I've continued to suggest that that's good. More on the market is good up to a point. Jason?
Yeah, I think there's even a little bit more of a story here that we could easily brush over. And one of the things that I'm seeing is that the inventory level is staying a little more static, a little more even, longer into the fall. It dropped off in the other years, like 17, 18, 19. And I was going to say this figure feels a lot like 19 to me, but when you look at the numbers and it's staying up there, that kind of means that there are people doing things that they normally wouldn't do in the fall. They're deciding to upgrade. They've waited long enough. We saw a lot of people that said, I just can't stay in my home, even though I have a 2.7% rate, and I'm going to move. And is that what we're seeing with this inventory, or are they literally just not selling?
I don't know what you're talking about.
The line level.
No, I mean,
up
I
on
see the
white
line. I'm trying to figure out if your glasses have some magical lens that allow you to see things in this data that I don't see.
If you look at these three gray lines,
It's less
they go down.
curvy.
They go down.
No, I actually believe if you're looking at this graph that you don't see December's data on this year's data on 25, and we actually did have that same drop off. In fact, we saw more listings go off market this last December than what is historically normal. And I don't think that is anything other than people were being advised rightly to yank and show up again next spring because things were going to be hot in the spring.
Well, they just sat on the market way longer leading up to December than probably normal. So they were probably at 90 days on market versus their house selling right away. And they're like, okay.
People were ready to take it off for a while and push reset. And I think that was the right move for a lot of people. But okay, so it's point number one, inventory is at far more normal levels, but I do want to just say that 17, 18, 19, if you have any memory, were low levels. 17, 18, 19, we were talking about how the inventory is crazy low. So we're more normal.
17, 18, but 19 started to creep up, and there were some people starting to get nervous, feeling in our office.
There was a moment where we thought the market was turning bad.
When did you get in the business?
17.
Okay.
Okay, so that's the inventory story as it stands. And Ethan, you asked earlier, does the local data match this? And I think the answer is emphatically yes. We're seeing the same trend lines here. So the next part of the story, we've got a new construction slide in there. It's just about there is no anticipated large increase in a new construction flood that in any way is going to solve or increase the inventory situation in any notable way. So the forecast for 2026 is just 1.2 million new starts. Last year, there were 1.3, and the year before was 1.3 as well. So nothing crazy happening in new construction, which means we're still technically an undersupplied market.
I'm curious as to why they think this number is going down, but the existing number is going up, right? The new construction projection is down year over year, but existing they think it's going to go up.
Inventory okay, I like that. So builders are not building because it takes a while for liquidity to show up and builders to want to have the appetite to go build a bunch of properties, right? So there's nothing that's happened that is making builders super excited to go make tons and tons of starts. And even if there was, it takes a while for dirt to get turned and for basements to get built. That's different than resale, where the resale inventory is going to tick up. And that's because of what we said earlier. This rate lock thing is starting to loosen up. And the rate of consumption was lower, right? We only had 4.1 million sides. And so inventory is starting to stack on. It's almost like the resale market is loosening back up. We were at a place, like, for example, Ankeny, Des Moines, I think 50-something% of our available inventory was new construction. In some markets, it was like 60 or 70. That tide is turning, where I think resale is starting to re-energize and re-normalize. So does that answer the question? Is that what you would
think? So yeah, it's just it seems like a big discrepancy.
I think
to me,
less builders are building. Cost of new construction is so much higher now. For a while, new construction and resale, like in 20, 21, 22, like you could buy a new construction home for essentially, I mean, not the same cost, but pretty dang close. And I think that gap is now much larger. And so you have less builders building, and you have the price difference in the two is more, and you have more available options on resale, which makes you have more sales in resale.
And you got more new construction sitting. I mean, some of these builders have some pretty high-end stuff.
And they felt burned as well, maybe over the last couple of years, that they don't want to keep doing that.
Whereas the resale,
they're scared to.
The resale sitting on all this equity from, I mean, the last several years because they've been rate locked and sitting there. But all of a sudden, that just eventually it catches up to you, and it's like it's time to move. And moving at 6 or 5.9 is viable from my 3, whereas moving at 8% from my 3% was just not fathomable. So I think I see that as just a healthy normalization of the market. We're getting to a slightly more common sense space.
Well, sorry to take us off track there.
No.
Keep going.
I think this is what people need, is to understand some of the data. Okay, so that takes me, I think, to what's next in our stuff, price. So we saw in this next slide 2.3% appreciation last year. And for reference, I think over historically 20, 30 years, 3 to 5% appreciation is the average that we tend to see. We know that in 21, 22, 20, I think it was 22 and 23, we saw 20% appreciation, correct? Was it 21 and 22?
21 and 22.
That's right.
Yeah.
And to your point earlier, Ethan, the rates did its job. It didn't take prices down, but it absolutely softened that appreciation. So 2.3 is modest, but not down. 3.8% in Iowa. And then projections for this year is the next slide. And basically 1.6% is the projected rate of appreciation. And this kind of takes me back to where we started this debate, right? Because, Chris, you're saying, but if rates go down, I don't think 1.6 is what we'll see, and that would be concerning.
Right.
I think what Tim's camp is saying is 1.6 is dismal, and we need more sales so that we can get our 100.
It feels like 1 point. Yes, it feels like 1.6 is not dismal when you take a look back to the last 3 years and see 40% in the last 4 years.
So we need another 1.6 because we need another year of call it pain.
Yeah.
In order for things to continue to normalize.
Several years.
The highest projection is NAR at 4%, and then the long tail takes us. Most of them are suggesting somewhere in the 1% range for appreciation. So what the talking heads are saying is that next year we're going to get to this more sales, and we're going to see rates come slightly down. But there is no suggestion on their part that anything's going to happen that's going to result in significant increase in prices. Your argument, though, is, until something stupid happens on rates, they get back down to 5, and all of a sudden that number's 5 or 6 again.
Yeah, if they light a fire on rates and we go down to 5%, all of a sudden I think that 1.6 number is way higher.
So anything more to be said on prices? Does anyone think that is a bunch of garbage data, or anyone want to argue with Lawrence Yoon? Or
I would say it's 100% right if there is no Trump effect. But we never know what comes out this summer when Jerome is no longer a Fed chair. And I think
to our point from last time,
going to be surprises this year that we can't predict today. My prediction.
Your prediction is that there's going to be surprises and we can't predict anything?
Yeah.
So actually, all these we can crumple.
I would wholeheartedly agree with that.
But if there's no surprises, this makes sense.
Okay.
So the third part of affordability, just because I was just at this conference, so they brought it up. So
wages.
Affordability is wages. So these guys are saying wages, they believe, are going up at a decent enough rate that makes homes more affordable. So what they think is, what is it? So rates are kind of baseline. It's not on here. I have a slide.
Oh, you were looking for it? Yeah, there was a slide down there.
Rates, wages, and prices.
Yeah.
Yeah.
So prices have modestly increased rates are baseline. So even if those stay baseline, rates go down a little bit and wages go up, to me, that seems like a good recipe.
It helps your affordability for sure. Yeah.
I don't know enough about the wages part of it to know if that was actually
It's only
good
slightly.
data.
It's outpacing. What I saw is wages are outpacing appreciation,
Yes.
but that's not saying much because appreciation was only 2%. So wages aren't skyrocketing, but the thing is, they need to not, because that was part of the inflation problem. So this entire fix the inflation problem, a large part of that was fixing wages, because you can't have 16-year-olds working at a coffee shop earning $25 an hour. It crushes the marketplace. So it's outpacing it, but I don't know that means that people are doubling their salaries, right? It just is incrementally increasing affordability. If rates are down, prices have leveled, and wages are slightly higher, we are slowly making the market more affordable. But I do want to say this, I've spent a lot of time thinking about this the last month or two. It is still a terrible time to be a 20-something-year-old compared to the past, entering the market and wanting to buy a house. It is more difficult than it has been. Fair? It's not affordable.
Yeah.
Agreed.
Completely.
Okay, so then...
Which is why the average first-time home buyer age now is 40.
40 years? That's a messed up data point.
I don't know.
It's real.
I don't know. I've seen a lot of old first-time home buyers.
A lot of old ones.
Yeah. Crazy.
It's this
Where
millennial
have you
crew.
been? Yeah, what have you been
In their
doing?
parents' basements is where they've been. Okay, the final data point I want to get to, because this is obviously the interesting one. It's directly connected to Chris's tattoo.
Yes.
That we are actively working to design. And so the next three slides are, one, projected number of sales for 2026, existing home sales. So that's resales. And that's where they're projecting 4.5. That's the 14% increase that we talked about last year, from 4.1 up to 4.5. The next slide is total home sales. So this would be new construction plus existing. And that's 4.7 up to 5.1. So it's the same presumed growth trajectory, very similar to the other one. And then new home sales is the final one, which is ticking up ever so slightly. So I think the slide worth looking at here would be the existing home sales. It's the reference point that, although we had some confusion about that is the number we were talking about 2 months ago. That's the tattoo number, 4.5.
Yeah, we all thought that the 4.5 number was the total, and apparently it is not.
So let's revisit that very quickly. Based upon your January, based upon where rates are now, it's been a couple months since our conversation. Does anyone want to make any wagers on that 4.5? Are we feeling still confident on where we're at? Is Chris getting a tattoo or not?
I think we're going to sell more homes this year than last year. Just the market's better. People are feeling better. There's a ton of people that they're just tired of waiting. They're not going to put off, regardless of what the obstacles are. They're going to trade homes this year. And we're going to get a healthy increase and a tattoo on Chris.
Selling more this year than last year, I actually agree with as well. But you're talking 14%. I still think there's no shot.
How much were you up last year?
How much was I up last year?
Yeah.
I was not up last year.
That's not a good one.
You just on here to make me feel bad? Is that what we're doing?
Well, I mean, my units were up like 20%, so that means that we could do it again this year.
Okay.
I think there's a lot of, it's been 3 years of 4 million.
Yeah.
And you made a case when we were even just chatting the other day that the reason we were at 6 million 3 years ago was because of ridiculous stimulus.
Yeah.
And so I think that's part of what your thinking is about, is you see the 6 million that happened in 22 as a function of, that's because there were 3% rates.
Right.
And it's not a bad argument. The question is that what actually created that amount of movement, or is that actually the pent-up amount of actual number of people who need to move in any given year? And the 4 is actually a suppressed number because prices and rates were high enough that it just wasn't affordable to make the move that they wanted to make.
So I feel like, to me, and I think I asked this last time, I don't know. I mean, it might be on no, it's inventory. To me, 2014 to 2019 was like whatever home sales there were in those years on average, to me feels like that's a normal market.
Our previous most normal space.
Most normal space in my lifetime. probably 20, because obviously before then you had 2008. Before then you had the bent up from 2008. And then, so the 90s, obviously probably less people moving. So like what was the, so that's, I should probably try to find that somewhere. Like how many homes are sold 2014 to 2019 on a given year? To me, that number, if that's 4.5, if that's 5.5.
Yeah, it was closer to 5 million.
It was around 5, yeah.
Okay.
Yeah.
So to me, that makes me feel like 5 million. That's kind of what I've thought is between 4.5 and 5.5. 6 million to me seemed like a lot because it was a lot.
Because inflation wasn't crazy. There was nothing crazy going on in the world. Rates were relatively normal. The only thing that was going on during that period of time is there was a recovery. So the only reason that story has some asterisk to it is that that market was on the back end of one of the largest housing recessions we've ever seen. And to what extent was that 5% inflated by catch-up that was going on because no one was moving before?
Yeah, so maybe 17, 18, 19, or maybe year 3.
Yeah.
Those were 5.5 and 5.3 all 3 years.
All of which are tattoo level.
Yeah.
Way
all
above
of
tattoo level.
Way.
And the rates at that time were between 4.5 and 5.5, probably, maybe 4.
Yeah.
Okay, but then that's back to Chris's point. Those are stupid
4.
low rates, guys. That's cheap. That's silly money.
And that's before all this inflation in the market, in the housing market.
Things were so cheap.
Yeah.
I remember saying we're going to look back and we're going to wish we'd bought more houses.
Yeah.
And
It's
Or
crazy
did-
how
I
you
still
walk
didn't
through
buy
a
any.
$300,000 house today that was, 170 7 years ago.
But I just don't believe anything changes moving forward. What's crazy to us today, 10 years from now, we'll have the same thing. Like these $1 million houses now that I'm looking at going, there's no way it's worth that. That's absolutely stupid. It's going to be $2 million in 10 years. And it's all just going to keep moving because this inflation system is built into our entire economic structure.
Yep.
Okay, what are you doing? You're like researching there?
Yeah, I wanted to see. Like, I mean,
trying to buy a
we're-
truck.
We're at like what you said was recessionary levels. That's where we are now. So.
Oh, yeah, below. Like we're selling fewer houses now than we sold during the Great Real Estate Depression.
Yeah.
That's why
my
Chris is
reference
getting a
point.
tattoo.
But,
I'm very
but
excited.
that goes back to my point from last time is you had it's the pull forward of home sales to 6 million. So it just balances out on the other end. That's all it is. It's not anything other than that.
Yeah, but if you do simple math and you pulled ahead of 1.5 million for a year or two, and you're down $1 million for a year or two, like when it's
And
going
your,
to level
and your
out.
population is up notably, and you're
But everyone's living in their parents' basement and they can't
For
afford
now,
and they can't
for
afford
now.
to buy a house anyways.
well. If they would just like stop buying Starbucks for a minute, they could probably
That's
afford to
it,
buy a
yeah.
house in
Yeah.
a year. Okay, I'm gonna get in trouble for that one. You know who you are if you're listening. I'm gonna get yelled at.
695.
I think I'm done on the data. I just wanted those reference points out in people's heads. The only other data point is projections on rates, which they're suggesting nothing major. Most of the rate projections were for like 5.9 to 6.1% by the third quarter of the year. I think you're right, Jason. There are outside stimulants.
Did this come out before the mortgage-backed security announcement? Do you have any idea?
Well, this would have come out around the 10th.
Okay.
And that was
About
announced
the
about
same time. Yeah.
I'm guessing they didn't know much about it at that point.
Right.
Yeah. So, okay. Let's
That
start
4.5 million number is now actually 5 million.
You're betting on
No,
Chris
it's
is
not going to be.
screwed.
I think
it's
we'd
not
be
going to be
safe.
5, but I think 4.5. I think in 3 years from today, we're back up to 5.2 to 5.3 million home sales.
Well, and so let's just stop for a second. We've
Minus
had
the world falling apart, which very well could happen.
that's
tomorrow.
always a
So-
thing.
I was going to say.
And the asteroid could hit and we could have nuclear war. But we're probably not going to. In most years, we don't.
In most years.
Yeah,
Thank
so
God.
far we're all still alive. Yeah, I guess I just want to think about what this all means. We had a record year last year as a company, but we were up 20%. We had some growth, some new team members, but on average, our people sold more real estate. And so when I talk about this, suppressed market, 4 million, it makes me think of you and like, what did you say? What was the quote? I'm not going to participate in this recession. So this isn't like things are bad. We've actually been crushing it in this suppressed environment. So I just want to, for anyone just maybe wanting to contextualize this conversation, for me, the thoughts on this are we've been crushing it in a challenging space. And I think the tide is going to start going up. And I think the winds are behind us a little bit. And I think it's going to be even easier to make deals come together because there's more options. The rate locked folks are starting to have, get liberated from some of that. Affordability is slightly increasing. And Chris, I agree with you. Let's not muck that up. Let's not throw a grenade in that. I'm excited for the year ahead, I think is what I'm saying. And I think that's what I would like you to be hearing. I hate the reason I'm not on Team Tim is because I hate the idea of spending any energy hoping that the market will change so my sales can go up.
Yeah,
I think that's silly. I'm interested in what can you do to be well positioned, but it should be a better year and an easier year to sell real estate than it was the last 3.
I
Like
agree with
last
that.
year, so 2020, what did we just get out? 2025, I don't even know what year it is. 2025 was our second best year we've ever had compared to 2021.
Your team or you or what? The
Both,
market.
Both.
Okay.
So beat 2020, beat 2022. The only year it didn't beat was 2021, which things were just ridiculous at that point in time. But so to me, it's going back to Jason, it's all noise. It matters and you should know about it, but we shouldn't let it impact us. You need to know it because you need to know how it's going to affect your clients and you need to know what messaging to put out there and how to communicate. But the more you dwell and the more you care what that interest rate number goes, because that determines your success, you got it all wrong.
Well, it's just energy misdirected, right?
Mm-hmm.
And so the more you can focus on where your energy goes, I mean, it's a real thing. You only have so much energy that you can disperse out there into the world. And so when you can take that energy and put it towards the right things and the right thinking, I think, in my life, God then, I think, gives you, this isn't self-fulfilling prophecy type stuff, but I think he rewards you with what you put your energy into, you're going to get back in some fashion. Now, that's not always the case, but I think it's versus the bad energy, the negative energy, you have to depend on X, Y, Z in order to be successful. I don't think that's necessarily a necessity. It definitely has an impact, for sure. You can't dismiss that, but to make or break your success based off of that.
Yeah. Well, that's the flag I wanted to put in the ground is we talk about all this data and it's easy to, not victim's the wrong word, but
You could get in the corner and suck your thumb.
what's the market going to do? It really doesn't matter.
Are you looking at me?
Why did you look at Chris when you
That
said
was
that?
that was an assault with your eyes. Jeez.
No,
God.
what I'm saying is
I definitely picked the right people. For that.
mindset is the most important thing. And I think the second thing, the data is great, but what I focus on in my business is what is historical cycles in the real estate market? How do you encourage people through whatever stage of the year we're in? Like, what is happening in the market? We know what's going to happen. It's going to get hotter and it's going to get busier. And if you want a deal, like these are the end of the deals right now. And that's what we're talking about. Last fall, buy when no one else is buying, because that's a great time to get a better deal. And then this spring, you're going to have to buy whatever is out there as fast as you can, because multiple offers are a real thing. And it's just always that same cycle.
Feels like it's going to heat up quickly.
Yeah, it already is.
Yeah.
We had multiple offers. I looked at a $629,000 house with some folks. It had been on the market 8 days. I texted the guy and said, "Do you have any offers?" He's like, "We're waiting on a second one." I'm like, okay. And it was just a house. There's nothing special, but we've already got multiple offers on $630,000 house. And my people wanted to write an offer. So crazy.
For what it's worth, I love to debate. I love to argue. I don't have the same negative energy that I sometimes bring to this group.
You just
with my clients.
push button.
I just want to say that and make that clear.
All right.
Your quote this morning was something along the lines of, "I don't watch KCM because it's just a bunch of positive realtor talk."
That's what it
Rose-colored
yes.
glasses. I get what you're saying.
And that's what it was when this stuff is really good for data. I don't disagree with that, but when it's just the spin that gets put on everything is, "Oh, this is good. I think he said this is
I
good."
actually agree
20
with you.
times.
But what I've learned to do is don't forget their analysis.
Yeah.
Just focus on the data. Make your own story.
But I would argue the story matters. Whatever story it's being told, story matters. And whether this is positive spin or not, what would you rather have the public? Obviously, you don't want a false narrative out there, but
Yeah.
if you have people thinking the world's ending, they're not going to buy real estate. If people think, "Oh, here's where we're at, and we got to be more aggressive," the news, this stuff. So to me, it's whether it's a little fluff or not, I think it matters to what happens out there because people are listening.
Well, the market happens, but also we can be market makers. I mean, consumer
it's like
sentiment.
a baseball card. Like a baseball card is just a baseball card until someone decides they really want that baseball card. Then that thing's not $5; it's $5,000.
I have a question, because what you're saying is that this. I mean, everything on this packet is historical data. It's happened. It's in the past. It's not did they change the numbers somehow? I don't know, but like it's really legitimate numbers. It's not their slant. And so I think if you're listening for this to figure out what happened in the past, that's probably a smart way to do it. If you're looking for it to tell you the future, no one can do that.
Yeah,
so
it's all just black swans. And
it's more just the positive spin that every time I watch those videos a lot. No, I don't want negativity. I want real, like what's
it's
real.
about authenticity for you.
It is.
You hate the idea that someone's like blowing smoke.
Yes.
And then you overreact to that, I think.
but
and
that's
maybe.
you blowing smoke.
What's me
You
blowing
blow
smoke?
smoke at me.
I'll blow smoke at you all day.
I am so excited for all the smoke blowing. I'm excited for. We have a Golden Circle Zoom meeting to kick off the year here in a few days. A couple things I was prepping for on that is just my thoughts on market conditions. And I just want to throw this out. I see two potential challenges, dangers, opportunities, strengths. Right? Is the thought process. What are the dangers in the coming market? One we've covered. We'll call it the affordability seesaw, and that's that rates coming down actually starts to have the inverse effect of, instead of increasing affordability, inadvertently decreasing it, right? So that's a real thing. That's a potential danger in the marketplace. Let's hope that that's not the case, because I'd rather things became slightly more affordable. Second one that we haven't talked about, I just want to hear your thoughts super quick, is an inventory snapback, meaning that there are people out there saying one of the dangers in the marketplace is sellers all just start flooding the market right now with their inventory. All these rate lock people dump their listings onto the marketplace, and we actually end up with so much inventory that we end up with a negative marketplace. Have you guys heard that?
If all the investors do that, but I mean, if a home owner sells their house, they have to move somewhere.
Okay.
Like they're doing it because they have a place to go. This was a problem, and when I got into real estate 17, 18, 19, it's like I would sell my house, but I cannot find one to buy. So some inventory might free up some more buyers.
And every one of those that enters the market is going to consume one somewhere else, so it's not a real concern in your mind.
Not at all.
I mean, inventory dropped 400 homes in the last month.
Locally?
Yeah, we were up to, almost 4,500 homes on the market in the Des Moines Metro, and now we were, last I looked, I haven't looked in the last couple of days, but
that wasn't
like around
consumption. That was just the December pullback,
but,
and then they all come back, right?
But that's what I thought. But then I looked, and there was like so this was right after the first of the year. There was 130 something expireds in the first 7 days. So out of that 400 to 500 less homes, only 130 of those were expired listings.
I bet a bunch were off
withdrawn.
withdrawals,
So
yeah.
I think it was, I can't remember, but I think it was only like half. So my thought was actually more homes had already started to sell, and it wasn't just all pullback.
Well, because they didn't stop selling. Sales continued pretty healthily through Christmas and through January, but the rate of new entrants stops, right? Like
Correct.
no one lists during that period, and then there were some withdrawals. No, I think you're right. What's the therefore? What are you suggesting?
Therefore, if those are already coming down, I do think there will be more. I think the demand, my hope is anyway, that the demand is stronger than the new homes coming on, that it might increase a little bit, but those homes will.
Yeah. Well, the projection's 10%, and a 10% increase on inventory is going to do nothing negative. In fact, I think it's even more positive. I still think that there's areas of the market where a few more options would be helpful, and frankly, a little more.
Just not townhomes in Ankeny.
Well, there's certain pockets where there's plenty, right?
Yeah.
I think the 10% is good and healthy. I think we got a little taste of the list side last year and how you have to actually be a good agent to sell houses. And I think we're going to have to level that up this year with the way houses are. I think houses are going to be sitting longer.
You have to be a good agent to properly list and market properties.
Correct.
At this point.
Yeah.
And set expectations.
I don't
with your
think that
client.
was the case 21 to 23. I think you could be any agent and list a house.
Yeah. No, it's great that skills matter again.
I mean, we list 70 to 80 homes a year on our side of things. And this last year was definitely like oh crap, we have to get our systems and processes back in place. Because we have to, but now and I told Jamie this and our team, like what last year taught us was like we grew a ton from it because we learned how to set better expectations. We learned how to properly keep in contact, communicate with them, make sure they understand all the data points of how we're marketing their home, what we're doing for them. So now moving forward, like if the house, now we have that stuff down and we became better agents out of that in my world.
And I think I'm excited for a world where there's more better agents. We should touch on that next time. I've not looked at the data on number of licensees, but it'd be interesting to see how much attrition there has been. I know it has happened.
923,000 agents did not sell one house last year.
Yeah.
And it's hard actually to get classes right now. They're offering less classes
for new licensees. Yeah, definitely the new entrance to the market, new licensees was way down the last 2 years. Anyway, I think I think Ethan's got places to be. You've got trucks to buy. What's your plan for the day?
I got no plan.
No plan.
No.
Cash is closing check.
Yep. Closing. I'm just going to go swim in money.
Okay, well, we'll see you guys in a couple months. If anyone wants to challenge any of us, you know how to find us. Tell us where we're right. Tell us where we're wrong. And the thing is, we don't know. We're just happy to argue it out and see where we land.
What did you say about predicting the future?
2 months from now is, from right now, will be spring break. So you either got to go before or after that. Just a heads up.
What?
Thank you.
Being very,
2 months.
Very literal. Very literal.
2 months from now.
It doesn't have to be to the day. Okay?
No, I know.
Okay, that's a good way to close. Appreciate you guys.
Thank you for joining us today. For more episodes, resources, and show notes, head to morethanmorepodcast.com.